Good morning, all. Good morning, all. I'm Dr. Amrita Tiwari. I share of the PPTs of cost of capital, the unit second of financial management. Basically, what is the capital? We explained here what is the cost of capital and what is the theories of cost of capital. We can start. Cost of capital. Firms raises required funds for the investment from the shareholders, debentures holders, and other providers. Providers of these funds invest their funds in the company with an expectations of the certain returns in form of the dividend and interest. The company has to pay interest and dividend to the providers' funds. Company has to earn sufficient profit to meet the legal obligations of payment of interest and dividend on the funds. If the company fails to earn sufficient profit to meet these legal obligations, it cannot be survived. Thus, while the investing funds, the manager has to ensure that it earns sufficient returns used to evolutions. Funds required can be raised either internally or externally. The internal source of funds is the best source of funds. Actually, it's raised through the operations. Ultimately, it's the constitutions of the difference between the amount to paid for the funds and the amounts earned with the help of funds. Finance management has to tap the cheap source of the funds and must invest these funds in the most probable opportunities. Must be careful while deciding the source of funds and applicable patience of the funds and investment decisions. For the purpose, he must first determine the cost of funds, otherwise known as a funds of funds. Meaning, the concept of can be viewed in two angles. It is the investor's view and the company's point of view. Cost of capital is a minimum rate of return expected by the investors or their funds investors view, and the minimum rate of returns to be earned by the company of its assets of investors company point of view. It is basically a cost of obtaining funds is that averaging rate of returns expected by the investors for supplying funds of the firm. Definitions. Cost of capital is the cutoff rate of the allocations of the capital to investment of the project. It is a rate of return on the projects that will leave unchanged the market price stock. The minimum required rate of earning or cutoff rate of expenditures. The rate of returns of the firms required from the investors in order to increase the value of the in marketplace. Based on the above definitions, cost of capital is not just a cost, it is an expected rate of returns and is minimum rate of returns to earn on investors meant to maintain the market value of the firm. As a rate of return, it has three components. Minimum rate of return at zero level, business risk premium, financial records premium. Cost of capital, normal rate of return at zero level, premium for the business level, and the premium for the financial risk. Significance of the cost of capital as a decisions criteria for the capital investment decisions. Accept or reject. IRR, NPV, and ARR. To determine the optimum capital structure, different source of capital with a different cost and rights. The right mix, the minimum, the overall cost of capital. The evaluations, the performance of the management at the different level and above the cost of capital. Other financial decisions like dividend policy, right issues, and working capital management. Classifications of the cost of capital is a historical cost, future cost, specific cost, composite cost, or combined cost, split cost, implicit cost, average cost, and marginal cost. This is the overview of the cost of capital. We will meet next video with the theories or theories of the cost of capital. Thank you so much.